All right, let's jump right in. We're talking about one of the boldest, most aggressive fiscal moves we've seen in recent American history, the California Billionaire Tax. And look, this is way more than just a new line in the tax code. This is a high-stakes showdown between a state that's desperate for cash and capital that is, for the first time ever, truly global. Today, we're not just going to break down the tax itself. We're going to lay out the exact blueprint that institutional investors are using to navigate what they are treating as nothing less than a declaration of war.
And yeah, let's be really clear about the stakes here. The state has essentially launched a fiscal offensive. And in response, well, the world's most sophisticated investors have drafted a battle plan. What we are covering today is that plan, step by painful step.
You know, when you boil it all down, this entire situation really comes down to one single powerful conflict. On one side, you've got California. It's a sovereign government, and it's facing these massive ongoing budget shortfalls, so it needs revenue, and it needs a lot of it. But on the other side, you have this high net worth capital that can move across borders more freely and more quickly than ever before in history. This is the collision we're about to watch unfold.
So let's get into our first section. To really get why the institutional response is what it is, you first have to understand the nature of the attack, so to speak. This isn't just some standard tweak to the tax code, oh no. The very architecture of this proposal is designed for maximum capture, and that right there is why it's being treated as a fiscal war.
So here it is. This is the weapon itself. The key phrases you need to lock onto are one-time and worldwide net worth. Think about it like this. A normal income tax, that just hits what you earn in a given year. This is a completely different beast. This is an excise tax on the total value of everything you own. We're talking your entire financial portfolio, everywhere on the planet. And here's the kicker. It includes unrealized gains, all those paper profits on your assets that have never, ever been taxed before. So why would you take such a drastic step? Well, the motivation is a number this big. $109 billion. That's the revenue the state thinks this one-time tax is going to bring in. Now, the proponents will argue this is absolutely essential funding, for healthcare, for education, especially when the state is staring down a pretty dangerous fiscal cliff.
Okay, now for the, brilliant, and some might even say brutal part of this legislation, let's really get into the technical anatomy of how this tax is designed to stop people from escaping. Because this is where the real strategic challenge for investors really lies.
Now, what is so crucial to understand here is that this is not a traditional exit tax. A normal exit tax, that hits you when you leave, right? You pack your bags, you change your residency, and boom, you pay a tax on the way out the door. This California proposal, it's much, much more clever. It's a levy that's based on your past residency. It literally reaches back in time to say, hey, you used to live here, so you're liable, regardless of where you are when the tax man actually comes calling.
And this timeline, wow, this just perfectly illustrates how that trap works. Just look at that first date, January 1st, 2026. That is the residency determination date. If you are a California resident on that one single day, you are potentially on the hook for this tax. But here's the crazy part. The vote doesn't even happen until November. So think about that. By the time you know for sure that this tax is actually going to pass, it's already too late. The trap was set nearly a full year in advance.
And the aggression doesn't stop there. It continues in how they plan to value assets, especially private businesses. They're not just going with fair market value, they apply a formula. It's the company's book value, so basically its net assets on paper, plus 7.5 times its average profit. But here's the real gut punch, the valuation floor. An entity cannot be valued below the price of any financing it took in the last 2 years. So just imagine you're a tech founder who raised a massive round during the AI boom of 2025. This rule could literally lock in that peak, bubbly valuation for tax purposes, even if the market has totally crashed by the end of 2026.
Okay, so that's the threat. Now, let's get to the real meat of this explainer, the response. This is the institutional blueprint being put into action right now by family offices and fund managers to shield capital from this exact tax.
The strategy really rests on 3 core pillars. First, you have to sever all legal ties to California, and you have to do it before that January 1st, 2026 deadline. Second, you move your assets into special legal structures, or wrappers, that put them outside the reach of the state's net worth calculation. And third, you proactively manage your liquidity to make sure you have the cash to either move or to pay when the time finally comes.
A really key tool here is something called an in-kind transfer. So instead of selling your shares in a company for cash, which by the way triggers a huge capital gains tax, and then moving the cash, you move the shares themselves. You literally transfer the asset directly into a new legal entity in a tax-friendly state like Nevada, or maybe a country like the UAE. The asset moves, but because no sale actually happened, that tax event is deferred. This is absolutely critical for moving those illiquid, high-value assets without taking a massive tax hit right away.
Now, one of the most powerful wrappers being used is something called private placement life insurance, or PPLI. I know, it's complex, but just think of it as a legal force field. When you place your assets inside a PPLI policy, they are legally owned by the insurance company, not you. This can legally exclude them from your personal net worth calculation. And on top of that, the assets inside can grow tax-free, and you get a really strong layer of creditor protection. I mean, it's a powerful trifecta.
And here is a fascinating tactical move that's happening on the ground. The tax law as it's written includes an exemption for real estate that's held directly by an individual. So for years, wealthy people held their mansions in LLCs for privacy and liability reasons. But now, they're de-enveloping those properties. They're dissolving the LLCs and putting the deeds right back in their own names. They're literally trading corporate privacy for a 5% tax savings on what could easily be a $100 million property. It's a pretty wild shift.
Look, this isn't just a theory. The capital flight is real, and the data is already starting to show us exactly where it's going. So let's move to the map and see which destinations are actually benefiting from California's policy.
Here in the US, there are 3 clear winners emerging. Texas is just a magnet for corporate headquarters. Think public storage, and it's got a booming angel investor scene down in Austin. Florida, no surprise, is still the go-to sanctuary for wealth managers and real estate capital. And then you've got Georgia, which is popping up as this really strong industrial alternative, attracting huge relocations like Yamaha Motor Company.
And internationally, man, the competition for this capital is fierce. Wealth is pouring into countries with these golden visa programs, but the undisputed champion by a long shot is the United Arab Emirates. I mean, you can see it right there, a 0% personal income tax and a visa that you can get processed in as little as 2 weeks. The UAE has become the premier global hub for capital that's looking for both speed and certainty.
But you see, this kind of capital exodus creates these enormous ripple effects. So in our final section, we're going to look at the unintended consequences of this tax, the hidden risks that don't just affect billionaires, but the entire financial system.
And here we are at the brutal truth for so many investors. You can have the perfect escape plan. It can be brilliant, but it is completely worthless if you can't actually access your money. As huge numbers of wealthy investors all try to pull their cash out of illiquid funds, things like private credit funds or real estate funds, to finance their move, the fund managers are slamming on the emergency brake. They're imposing liquidity gates, which contractually limit how much money can be withdrawn, all to prevent a fire sale of the fund's assets.
This slide breaks down the tools that managers are using. You've got liquidity gates, which cap your withdrawals, redemption fees, which basically penalize you for taking your money out, and you gotta watch for PIK interest. That's payment in kind interest. That's a major red flag, where struggling companies pay their interest not with cash, but by just issuing you more debt. It's kind of like paying your credit card bill with another credit card. So the accrual irony here is that just when people need cash the most, the market itself is locking it down. Your money is trapped.
And this chart, this perfectly illustrates the ultimate risk for California itself. The state is projecting this massive revenue gain, but that number assumes zero behavioral response. It assumes nobody leaves. History tells us that is never, ever the case, because the top 1% of earners pay nearly half of the state's entire income tax. If even a few dozen of these top billionaires pack up and leave, the loss of their annual income tax could actually exceed the revenue gained from the one-time wealth tax. The state could end up with a net loss.
So, the crucial point is this underlying structural problem. California is trying to solve a long-term issue, these huge fixed costs like pensions that are funded by a super volatile revenue source like capital gains, with a short-term one-time fix. It's like using a credit card to pay your mortgage. Sure, it might work once, but it doesn't solve the fundamental mismatch. And it might just push the state towards an even bigger budget cliff down the line.
Which leaves us with this final massive question. Is this initiative a necessary solution to fund critical services, or is it an overreach that's going to act as a catalyst, accelerating a permanent geographic shift in where wealth is created, managed, and based, not just in America, but across the entire globe?
The answer is going to unfold over the next few years. But the blueprint for action, that's already being executed today.